Good day, fellow investors. JDE Peets Coffee, the largest coffee company, tea company in the world, trading cheaply. If we look at the stock trading in Amsterdam, P ratio 15, dividend yield of 4.28%, it hasn't had a good run since going public in 2020, but let's look at the company, what's going on, make an analysis, intrinsic value, and start from there. So it's Douwe Egberts, the Dutch tea and coffee company. They merged with Peets Coffee in 2020. Since then, things haven't been great, but this is something very important. Look at what just happened. JDE Peets shares surged after majority holder increases majority stake in 2.4 billion deal by buying Mondelez's stake. So they paid 25 euros recently for the 17, 18, 16% stake of Mondelez, more than the 16 euros here that the stock price is trading now. So the value of the stock to private owner is 25 at least, and we are now trading at 16. So that is a way to look at the margin of safety. Also, another reason why it might be going down is that this traded on the Dutch stock market. Dutch people are now focused on great AI returns, chips, that might make it overlooked. Let's look at the financials, the business, the intrinsic value, put it into the value quadrant, and discuss the risk and reward of investing. You're here for that. Subscribe and smash that like button for more. Let's start with the business. These are the brands there: Senseo, Pickwick Teas, JDE Peets Coffee, L'Or, Douwe Egberts. So very famous global brands there. You're probably drinking or having some of this in your kitchen. They have also made some acquisitions: Caribou Coffee, Maratha Coffee, a little bit expensive for my taste, 16 and 13 times EBITDA multiple, few times revenues multiple, but okay. There are also the Peets restaurants, mostly in San Francisco from what I see, but they are slowly growing across the world. They are from Amsterdam, of course. They started, the Dutch Douwe Egberts merged with the coffee division of Mondelez International, which made then Jacobs Douwe Egberts, that then merged with Pitt Coffees and then went public in 2020. Listed in Amsterdam. And when it comes here to a little bit of history, Mondelez Coffee merged, and since then things have been okay. They have recently lost the CEO, now found a new one, but in general there is negative sentiment, but it is also a fresh company, so maybe also something that pushes the stock down, an overlooked food company. So they are expanding, doing their business. Passiona Rossa doesn't sound like Italian, but okay, we can laugh about it. They are doing their thing. JDE Peets, vertically integrated channels, because of the long time history, they know how to get to their coffee. Good brands, even if brands today are a little bit shaky. Nestle, Starbucks, local coffee, everyone is grinding their own coffee now. So that's also something. We had a management issue, but there is this holding company that owns the majority of shares now. The management issue has been solved. Rafael Oliveira is now the CEO, coming from Kraft. He has been there, the international president of International there. So they found likely someone who will do good in continuing with the company. The owner here, it's a holding company. So holding company with 50 billion of managed capital from various investments, European investments, and they are owning Dr. Pepper, for example, Panera, Pret-a-Manger, Krispy Kreme, things like that. So they have significantly invested, and JDE Peets is one of the key holdings there, and their focus is cash flows, maybe even sell it at a good return over time. So a good company, likely good brands, not the greatest, most famous brands, but those brands that are always there, and they are doing well financially. Let's look at the financials. Organic sales growth 3% over the last quarter of the year that we have the results. Good organic growth on profitability. Free cash flow good net leverage, a little bit high, because they have, as I said, bought those two companies. If we look at the growing there, we have some volume growth, which is always positive, price growth, then geographics, emerging markets are growing really good, global brands are growing, and the rest is okay, nothing special, but okay. Gross profit increased on the pricing likely mix over there, so that benefited. Also good cash flows, but they also increased the debt to almost 5 billion euros. But you'll see later a key factor when it comes to that debt. The coverage is there, their target is 2.5 times, so if EBITDA goes higher, then that's easier, but also they need to lower debt, so they're likely pause on buybacks until the debt is lowered. And this is the fact that we must understand. When you have the average cost of debt at 1.1, that's not free money. Someone is paying you with 3-4% inflation, someone is paying you to use their money. That's insane. And therefore, even if you look at the maturities of the cheap debt, they have the cash flows to repay the debt every year. So that, from that perspective, should not be an issue if they don't breach any debt covenants. And if you have so cheap debt, then of course it is smart to make those acquisitions. And therefore, something that can also be a positive at the same time as it is a risk. If we look at the capital allocation priorities, growth going forward, targeting the leverage of 2.5, maybe doing acquisitions, dividend, stable dividend, growing over time, and then perhaps share repurchases when that is lowered. Now, they are looking for 850 million of free cash flows, but that is also from the release of inventory. So if we look at the financials there, slow and steady growth here, maybe a little bit faster now with the acquisitions. There is a lot of goodwill, but that's also thanks to all those mergers. Long-term debt has been higher, IPO, and then keeping it there, but that's always, if the debt is so cheap, then it is something. They did once buybacks of 500 million, but the dividend there is stable, and that's likely their plan, which then also finances the holding company there. Let's do the intrinsic value calculation. I have added it to our intrinsic value template. You can download it, of course, for free in the link in the description below on my free value investing course. Now, I have put earnings per share here, 1.1 euros, a little bit lower than the free cash flows, but that is because of inventory releases. The dividend payout ratio is around 65% on the earnings. If we put 5% growth there, 10% discount rate, and a multiple on earnings, which is now around 15, all else equal, the intrinsic value is around 15 per share, for a 10% return, which is not far from the current stock price of 16. So this is the deep value that we'll also discuss. And this gives you now a 9%-10% return over time. Not bad. If the interest rate environment goes better, then you can get even a higher return, 10-12%, as growth could be better, especially if there is inflation and things like that. So not a bad situation to be in. The worst case scenario, the margin of safety, then we have slower growth and the lower PE ratio, which is always possible, and for that would be another 30% down, worst case scenario. But stock price here now, we go back to the comparative table, and 9-10% return should be there for JDE Peets. Nothing wrong with it. And you have to see also how the dividend fits your portfolio. I have put it also on the quadrant, somewhere here, 8-9%, a little bit better than the Kraft Heinz's, the Schwab's, the Nike's, McDonald's, the Nestlé's, cheaper of course. So on the higher side here, nothing wrong with it. And perhaps another thing to discuss is the margin of safety value to owner. We have seen them paying more than 70% on the current stock price. So if there is a takeover, stock price just keeps on going lower, they will find a few billion, buy you out, and then you have also that margin of safety return, or margin of safety from the downside, from value to private owner. Here it is. So they pay 25 euros. So if they pay 23, or that's a Dutch company, likely you are protected, they will pay 25 also to you, which is a great return on investment. Here is the summary. We have global coffee and tea consumption growth opportunities growing in emerging markets. Profitability, they have good margins, they have a vertically integrated chain, good brands, good dividend of 4%, emerging market growth. Risk, there is always competition, Starbucks, Nestle, material cost, inputs, and currency risks, macroeconomic headwinds, but that is always there, the standard. I think the key is how will we as customers go around those brands, because yes, there is a positive global tailwind, which is always positive. But this is an example of deep value, and we'll keep focusing on such things. Thanks for watching. I'll see you in the next video.